right. So, Gautam, we are live now.
Awesome.
All right. So, just want to set some framing here. So, I just want to say thanks to everyone for joining us from wherever in the world that you are today. As an introduction, my name is Sam. I'm Chief Investment Officer here at Goldfinch. And today we're here to talk with Gautam, one of the managing partners at Almavest, an emerging markets focused impact fund, and to go through our AMA and talk about your upcoming $2 million raise to drive more financial inclusion in emerging markets. So just with that, the context has been given thus far. Let's just dive into this.
Sounds great.
Okay.
So you're the Q and I'm the A, right? Just to confirm.
What was that?
I said you're the Q and I'm the A, right? Just to confirm.
I hope so.
Okay. All right.
So with that, just to kick things off, Gautam, can you just tell us a bit about you and your team's background so we can just have some context for everyone?
Sure. So my name is Gautam Ivituri. I'm, as Sam mentioned, one of the principals of Alma, and I've spent about just over 20 years, most of it in emerging markets financial services. About half of the time I've spent working in larger organizations like I've been on Wall Street and the World Bank Group, and then the other half really setting up, running, investing in, and advising impact businesses around the world. So a lot of my experience is in South Asia, but also East Africa, but have been on the investing side in many different regions in emerging markets. And what's been really exciting for me has been seeing over the last, over my career, the last 20 years, how much technology has changed everything that this space is about. So when I started in microfinance, we would walk out, or drive out in a Jeep to a village in rural India and sit in a circle and hand out cash, collect cash on a weekly basis. And that was, the traditional microfinance lending model. And then, within a few years, it became sending money via M-Pesa in Kenya, mobile money to people's phones. And here we are now working on a completely new ecosystem built on blockchain. So that's been, sort of for me, the highlight. But, as I said, my experience has been on the lending side in inclusive lending. And my partners also have, about 20 years each lending money to low-income populations around Latin America, the Caribbean, growing and scaling those businesses and investing as well.
Fantastic. And maybe double clicking then on, for example, Kenya and M-Pesa digital money, what are your general thoughts in terms of what has basically these digital rails essentially enabled across with regards to lending and the work that you're doing in emerging markets?
Yeah. The tool is super powerful. So one of my former colleagues was the founder of M-Pesa, and what they built in Kenya to start, where today almost I think half the adults in the country are using it as a way of moving money, paying for things, sending money to relatives, etc. That has changed the economy at a retail level. But for us, where we're talking about things like credit, what it has been exciting is now being able to actually look at all the data that people have accumulated on their transactions, their wallets, and then being able to make credit decisions against that. So on paper, it sounds amazing, and it's something that we've been very excited about. In fact, we started probably the first digital credit business that morphed into something the banks took over in Kenya called Mshwari. But at the same time, there's a downside. What you're seeing is because almost everybody's connected, and anybody who's a warm body with a phone can now get a loan, you've got so much lending to people who probably are not creditworthy. And you've had, people who take money, are not able to pay it back, don't pay it back, and then for a $20 loan, get a black mark on the credit bureau, for example. So, these powerful tools, we always have to kind of look at both from a positive and a negative angle, and a critique kind of, approach. But I think in general, these have been super powerful for the work we do, just in terms of getting credit access to millions and millions of people who didn't have it before.
Yeah, that's fantastic. And I would say or echo that in terms of its ability, and by that I mean mobile money and the various forms that it takes, its ability to impact and basically touch people, not just in East Africa and Kenya, but also across Southeast Asia, MENA, and Latin America. So with that, then actually this takes us to our next question, which is, so why did you start Almavest?
So, I had spent so many years actually being on the operating side with having, I was the CFO at SKS, which is a microfinance institution that went public in 2010. I was the CFO in the early days, and then, set up other microfinance businesses, digital lending businesses to SMEs, this credit business in Kenya that I mentioned. And my partners, again, as I mentioned, have that operating experience. And we saw a real need for very flexible, creative debt capital that would help businesses like the ones we've been involved with scale and grow. And so, a lot of the lenders in these countries where we do business, they borrow money from banks. But banks are not very flexible. They want to make sure you have a long history. They usually want to see that you're profitable. They're not the right guys to go to earlier in your life cycle. And then if you want to go to development institutions, that can take a year to raise money. And of course, they've got their own long list of, so, we needed something, and I think the world needs something that is flexible, secure, but really takes advantage of where these fintech lending businesses are and the scale that they're going to achieve. And we thought Alma would be a great, business to be able to run to do that. So that's why we started it. And we also saw obviously a huge appetite from the folks who are hopefully watching this and institutions to be able to earn a yield that is safe, that is also doing something worthwhile. And I think putting those three things together, we're still at the early stages of finding opportunities like that, in the finance world. And so I think there's a tremendous amount of growth that we can achieve, and hopefully with Goldfinch, together get to a large scale.
Okay, that's fantastic. Maybe a bit of a curveball, but just actually Almavest, the actual name, what does it mean?
Alma is we kind of alternate between calling it Alma and Almavest, but Alma is soul, and interestingly, it's soul in Spanish. Atma is soul in Hindi, in Sanskrit. So I don't know why those are very close to each other, but they are. But we just like that. We just like that name because we're all kind of spiritual guys, I think, in one way or the other. So it appealed to us.
Okay. Bit of spirituality is what we need nowadays. Consider everything that's going on, but I digress. Coming back to Almavest, though, talk to us, about your general investment thesis. So generally, where do you focus on? What type of industries you look at? What type of debt do you provide? Or what are these typical terms, and so on and so forth?
Right. So, we like to focus on what we know really well, which is lending to lenders. So, we call them inclusive lenders. They could be fintech, they could be microfinance, but they're working with underserved groups, consumers, small businesses, micro enterprises. So that's our focus. It's sort of the bread and butter. And then we've been building a second business line in carbon project finance. And when I say that, what I mean is, there's people who go out there and they either conserve a forest or they give a family a cleaner way of cooking that burns less carbon, less firewood, for example. Or they go to a school and say, hey, you don't have to burn firewood to clean water anymore. You can actually just use this tablet and you can clean the water without burning carbon. So these projects all generate carbon credits and they all need finance. And so to me, that's a very timely and huge opportunity that makes us feel good and that I think brings in good returns and can be safe. So that's our second sort of industry. And then we do it all over. We're including, developed markets. We look at the US, we look at the Middle East, we look at Australia. We'd love to do something in Eastern Europe, so a number of opportunities poking around there as well.
Okay. And in terms of the capital you provide, what form does that take? So in terms of the debt, are you senior lenders, are you mezzanine lenders, junior lenders? Talk to us about the way, what your typical terms are, and as well as with regards to tenors and whatnot.
Right. So rather than have kind of a very fixed sort of dogmatic, hard and fast lines, we like to be very flexible and creative. So, almost always we're senior secured lenders because the most important thing is getting the money back. It's very easy, whether you're lending in microfinance or anything else, to put money out, but getting it back is never easy and takes a lot of care. So we're almost always senior secured lenders, but there are instances in projects that come up where we feel we can be a mezz lender, meaning there's somebody sort of covered ahead of us. But we can be that mezz lender and still be very safe and still earn a very attractive yield. So that's usually where we play there is the senior side. And we either make a loan directly to a company, or in some cases we set up a structure, and that structure buys the loan receivables from somebody originating those loans.
Okay. And speaking now down to the level of the teams, the inclusive lenders, or the basically carbon borrowers and whatnot, can you describe what is your ideal sort of borrower? How old are they? What are their financials like? How much have they raised? Which track record do they have?
The most important thing for us really is experience. So it really is less important whether the company is 1 year old or 5 years old. If this is a group of entrepreneurs or a team that has done this before, whether it's on the carbon side or whether it's on the lending side, and they've learned some hard lessons in their past, that is usually very important to us. Because we've been at this, each for 20 years, and we've made so many mistakes, and we know all the things, or many of the things that can go wrong. And so we always like to be in business with people who have that, humility, I think. Humility and, hard knocks that they can learn from. So that's the most important thing. So we've done companies that have, 1 year of lending experience, it was a very experienced team, to, companies that have been around for 10, 15 years. And, we look at projects that have a history of lending out maybe only $1 million so far, all the way up to companies that have done a few $100 million worth of lending, for example, that we're ready to finance. And if they don't have a lot of experience, then it's important for us that, they're willing to let us advise them, or they have some very strong equity investors. So we know there's a lot of cushion to keep us safe.
Okay, got it. So just repeating it back, really, experience is, above all what you're solving for, and then following that in terms of what you're sharing before, actual contractual deal structure, in terms of just making sure that you're ideally one of the first to be paid or the first to be paid with regards to the borrower making any repayments.
Correct. Thank you. Yep.
Okay. So just diving a little bit deeper then, in terms of just generally Alma, and when I think Alma, I mean just your general teams across the various funds or entities that you lent out of. Just talk to us a bit about your track record. So essentially, how much have you lent out to date, and basically taking into account any sort of defaults and whatnot, what have the returns generally for you all been to date, and where have you invested thus far, as in the current team that you're in, or what countries?
Sure. Yeah, sure. So we've committed just north of 20 million to date. We've deployed just north of 20 million to date and committed just north of 30 million USD. Those have gone to both inclusive lending and carbon projects in countries including India, Singapore. The Singapore company runs a project in Zambia, so we've got Zambia sort of risk. We've made a loan to a carbon project that's doing business in Nigeria and Kenya. We've made a loan we're making a loan now to a Panamanian lender, a Mexican lender. So it's across regions. We think the most interesting opportunities that we found so far happen to be in these emerging markets. And what else did you ask me?
So on the back of how much, actually before that is just for everyone's benefit. So you said that you've essentially lent out 20 million, you've committed 30 million. What does the committed mean? What's the delta?
Committed means that they're going to take it in tranches. And so they've taken the first amount, and we've committed to them that we're going to deploy according to a certain schedule this remaining portion of the loan.
Okay, fantastic. And then after that, now in terms of executives you mentioned, it's generally like a bit, you can lend out, but also what matters is the capital coming back in. So what have the returns to date been that you've seen?
Right. So like Goldfinch is set up to have a backer, community, we have some family offices and our own capital, which is taking, we call it, say, the mezz piece of any loan we make. And so those have been in the low to high sort of double digits, teens, not sort of 99%, but like 10 plus. And then senior lenders tend to be in the high single up to about 10% returns. So those are the safest guys, but still earning a very good return.
Okay, got it. And the next one is just a bit more of maybe a more of a selfish question, but really in the context of working with the Goldfinch protocol, why are you basically working with the Goldfinch protocol? What brought you to it? What interests you in it?
Right. So for me, I think that what Goldfinch is doing is the future, in the sense that everything we've talked about. Why did we even start Alma? Is really because we think that these opportunities around the world for people to realize high impact, strong yields, safe investments, and I think that's something that's universal. That's not just institutions. It's not just hedge funds who are going to do this, who want to do this. It's individuals. We have with Kickstarter. I remember when Kickstarter was founded, and I had a chance to meet one of the founders. That is an amazing opportunity for people in the U.S., let's say for now, to really back projects they care about. And so that kind of democratization, or expansion of all these opportunities to retail investors, I think is an amazing. That's going to be the way. That's the way the future is going, for sure. That's number one. Number two is, I have some experience starting a blockchain project that we're now using as Alma called LendLedger. And the LendLedger project is designed to actually take all of the lending activity we do and all of the collateral that we get and put it on the blockchain. And we think that makes it, very transparent. Everybody can see exactly how their loans are performing. That then creates a basis for actually trading those loans. So for me, it's always been about, where is this all going? And where this is going is we can all own bundles of loans that we like. We can trade them. They can be liquid investments. And given that small business lending around the world is a multi-trillion-dollar market, I think this is a humongous future that we have ahead of us. And to me, Goldfinch is doing everything right to kind of put this together. So, it was a no-brainer for us to want to be involved with you.
Okay, I mean, I can also echo that with my own background, having spent over a decade in traditional finance space, partly in Europe and then most recently covering just the whole of the global south, or in other words, emerging markets, driving financial inclusion, and just trying to be on the bleeding edge with regards to using different tools that are out there to be able to help people get access to credit whereby they otherwise haven't been able to get access to credit. It's something that's also deeply important to me. So can definitely echo what you're sharing. Now, coming back to Alma, and just also thinking about this with regards to what you were raising, can you tell the people, essentially, or tell everyone, how is Alma structured with regards to your entities, and how will the funds be used, and also generally with regards to how you're structured? It'd be good to hear a bit more about, you mentioned this earlier, who are your backers? And by backers, I mean the different constituents that are helping you make this happen. You have some investors, you have some key counsel that you work with, some advisors. So, let's look underneath the hood and see how you're making this all work.
Right. So we've designed Alma for now to not work as a fund, because again, we believe in being flexible and letting different kinds of investors participate in these opportunities. And so we thought the best way of doing that was to be more of a corporation or a corporate structure rather than a typical investment fund where, it's open for 5 years, you put in money, you can't take it out except for certain periods of time. It's closed once it's filled up, et cetera, et cetera. So this is structured where we have different entities, special purpose vehicles that can say, okay, this vehicle is going to do carbon deals and people who are interested in that can back that. Or this particular entity is going to do a diversified set of inclusive lending deals, et cetera. So that's kind of what the corporate structure looks like. It's separate entities, all managed by our, sort of operating business, but designed to bring in different deals and bring in different sets of investors. And then how we make these happen is, we have an investment committee that consists of our 3 partners, the principals of Alma. We have certain backers who include, and they're listed on the data room that some folks have access to. Crescendo Asset Management, which is a fairly large European-based and US-based wealth manager and asset management company. and some family offices. And so we have representatives from these folks who are on our investment committee, and then we make the decisions on what to do with capital. And then, as you mentioned or referred to, we've got counsel both in the U.S., specifically for Latin American deals who are Spanish speaking. We've got counsel in every single country that we do business in to make sure that when we make a loan, when there's collateral, we're able to take that collateral and quote unquote perfect it. Perfect is the technical term to mean that it's actually legally binding and we can get access to it as needed. So we also have a very special relationship with an analytics company called Quash, which actually helps us both originate deals but also vet deals at the level of looking at their data analytics, looking at their machine learning models, and making sure that anybody we're lending to actually has really good lending decision making at that level. So there's a bunch of pieces that make up the Alma ecosystem.
Okay. I definitely would love to double click on the Quash and the analytics later on. So just put a pin in that. Moving on with regards to the basically, open question is like, how do you actually find all of these teams that you want to work with? The world is a very big place and there's many countries you want to go to.
Yeah, I think having done the work we've done in all these countries as long as we have, it's feeling smaller and smaller these days. Nowadays it sucks that we can't travel like we used to, but the networks are still very strong when it comes to entrepreneurs in these markets, when it comes to investors, when it comes to even folks at organizations like the IFC and the World Bank, who are investing from a global level, in financial inclusion. We have partners like Quash, who I mentioned, but yeah, all of these relationships are really driving the pipeline that we have. And so we're expecting, to be able to do over 100 million in transactions within the next 12 months or so, just given how much volume we have and, how our process has been working so far.
Okay. And actually, perfectly segueing, actually, because you mentioned process, is when you get down to the details, talk us through it. Like, I know you shared this in the data room where there's this left to right hand chart that speaks to what your process is, but essentially, what is your process? How do you determine who you want to work through? What stages do you go through? And essentially, like, what frankly differentiates your ability to pick the right teams to partner with? Because earlier you had specifically mentioned it's very, it might be easy to put money out there, but it's pretty hard to get it back. So you want to make sure that the people who are borrowing have the ability and willingness to make the payment to your end borrowers, who then on pay to you.
Correct. Yeah, the first phase really starts with a phone conversation or meeting with someone we've been referred to, just to really understand how their business works, what their kind of motivations are, where they're headed, what their needs are. And if we think there's a fit at that level, then we go into a screening. And the screening really is about the data. So that really is about looking at, how many loans have you done, how have they performed, show us every payment that's ever come in on any loan you've ever done, so we can see how regular those payments have been, what has happened during COVID. We've got, I've lived through, the global financial crisis and seen what that did to loan books. I was in banking early on when we had the ruble fall and the emerging markets, currencies came under pressure in the late 90s. So, we've seen all these things happen, and we want to see how these loan books that we're looking at have performed similarly in, the stuff that's happened over the last few years. So the screening stage is a lot of data and understanding how they're set up and how they've operated. And then the final phase, if everything goes well and we feel like we have a deal we want to do with this particular company, is to do a full due diligence that includes a lot of detailed analytics, legal structuring, background checks on the people involved, et cetera, et cetera. So you asked a good question about, how do we know we can do this and not screw up, or, what sort of distinguishes us? And for me, I think our experience is the biggest part of it. I think, we're finding companies that others generally aren't able to find because of the relationships we have, number one. Number two, as I said, we've made tons of mistakes, whether it's with partners or whether it's how we loaned or whether it's the incentives we gave loan officers, all the things that these guys are facing who are running, these men and women who are facing who are running these companies, we've been there. And so I think that allows us to see where their stretched where they may be messing up, and maybe where we don't want to get involved. And then, of course, we've got, the data systems and the analytics that we've talked about that help us analyze how well things are going.
Okay. Got it. And actually, thinking about switching up a bit here is, how about just to set some framing, we talk about a particular borrower in terms of how you chose them, and let's actually, talk us through your end-to-end process, and then on the back of that, we can zoom just a bit out, and then talk about, because as you mentioned, it's easy to put money out there, but basically risk. How do you manage post-investment risk when it comes to credit, operational, and foreign exchange and whatnot? But coming back to this question is, let's do a case study in terms of how you found them, what the process was like, any sort of analytics you used to make a decision, how you structured this, so on and so forth.
Yeah. So, we can take the case of a lender in, maybe we'll sort of do two, one that we did and one we didn't do. That might be interesting. Okay. So, we could take the case of a lender in Latin America, and I won't get into all the names and everything just for sake of confidentiality, but I can describe it quite well. So, they've been lending to both consumers, which is almost all of their business, and to small enterprises a little bit. We found them through someone we've known who worked at a different lender, who's part of our network, who said, hey, these guys are good, you should talk to them. We first scouted them out with some background checks through our networks to make sure these were legitimate entrepreneurs and operators. And then once we sort of got that comfort level, we got into the data side of things. And, given that they have a few different lending products, we had to be really sure that, there's no one product there that is growing at a pace that is immature, that's actually going to torpedo the portfolio. And so when we crafted what our loan was, we said, look, our loan is for this, our loan is not for X, Y, and Z products. If you're giving us collateral, this is the collateral, don't give us this as collateral, So it was really a lot of focusing on their best product and making sure that's what we were financing. Should I talk about one we didn't do and why not, or is there more we should go on this one?
I'd say on this one, if there's anything else you can share specifically in terms of, because you highlighted they had multiple products.
Right.
You made a conscious decision to focus on one product. So what did you do to be able to understand whether or not you should or shouldn't finance that product? And also, given information is so opaque in emerging markets, how did you, for example, verify that all the information that they share with you is real?
Right. So, just to sort of vet the business, we did interviews with people we know in the market. We were in touch with representatives of international organizations because, I used to work at the IFC, so I have relationships both with the IFC and similar organizations. IDB, sorry, I was forgetting the name, the Inter-American Development Bank, in Latin America. So we were able to talk to people and vet that this company was legitimate. We spoke to
sorry, just to interrupt there, just as context for everyone, what is the IFC and what is the International Bank for American Development?
So the IFC is the private sector arm of the World Bank, meaning it actually gives loans to companies, not governments. And they do, I think $10 billion a year of disbursements, plus or minus. And they have teams in almost every emerging market working in financial inclusion and other sectors. And so if you want to know, who's kind of legitimate, who is not legitimate, who's got a good reputation in almost any country, it's handy to be able to call the country head or an investment officer there and find that out. So we did those kinds of checks, to get as much insight as we could. The other thing we wanted to do specifically in this country is make sure that the regulation wasn't going to turn against us. If you're lending to consumers, and this particular company lends at relatively high rates, we wanted to be sure the government wasn't going to say all of a sudden, hey, those rates are too high, you guys have to cut them down, because that would severely impact the company's ability to repay us. So we also did some consultations with people in the microfinance area who deal with the regulators to understand if there are any trends like that that might hurt us. So that was a big sort of piece of the due diligence.
Okay. So here you spoke, basically, just to repeat it back, a macro review, or thinking about regulations and just how the country operates. And you also did a lot of references with regards to speaking to people who are familiar with the country. Did you do any work in terms of the actual portfolio to understand the repayment terms or how people, cohort analysis, so on and so forth?
Yeah, this company has a lot of data. They have right now about 150,000 outstanding loans because the loans are small, about $150 each. So there's a lot of data to sift through. And so we took everything, every loan they'd done, looked at it all through COVID, looked specifically at, when you make a loan and the loan lasts for 5 months, are people paying regularly or is there some kind of problem? This company is interesting because one of the things they do is they lend for cell phones. So a customer walks into a store, wants a cell phone, this company will give them a loan, but they'll also provide a little app on the phone that will brick the phone, basically make it unusable if the customer doesn't repay the financing. So, it was important for us to understand how have those partnerships gone. Let's say that the company that's providing you this app, the software you're using to brick the phone doesn't work. How well does that work? How long has that relationship been in place? So there's a lot of stuff just around how their business operates that we needed to get into to make sure that this wasn't going to. There was no way that this could really turn dramatically south on us.
Okay. And when you just actually speaking to the product, tying this back to the mission, why are phones important in emerging markets?
So for mission, I think there's two aspects here. Number one, you're giving loans to people who have no credit history, who have no, ability through their documentation to actually get a loan. So you're kind of taking a bet on them. And so that's important because somebody's got to do that. The banks are not going to do that. So a company that's doing that, I think, is worthwhile because it's bringing more people into the system. And then if the customer repays, obviously you've created then a nice history that's public that lenders can look at. So you've helped these customers kind of get more integrated into the financial system. So that's number one. And then number two, phones are valuable to your question because phones are, people's access to job opportunities, to connectivity, to social networks, to, actually running a business. So there's a lot of, value in obviously being connected and that's key.
And actually, this from my own personal experience, just peppering this in, is the third bit is with regards to phone. The practicality is it brings you into the financial system because in many countries you can actually send or receive money through your phone versus if you live in rural areas having to drive hours and hours to a local branch. It's basically equivalent of saying, in the US, having like a Cash App or Venmo, being able to move money around as you like, versus having to go to a rural bank branch.
Totally.
Okay. And now, so flipping it over though, so we just spoke about a team and that you ended up working with, going through all those aspects that you spoke to. Talk to us about a team that you ended up not choosing to follow through and why you didn't choose to follow through with them.
I mentioned I have a decent amount of experience in Kenya from the early days of M-Pesa when mobile money was really taking off. And we spoke early on about how what you just said, that people being able to Venmo or PayPal each other, which is now so commonplace in the US, but when it was starting in Kenya, we really didn't have it over here, but it's taken off so well there. So we've been excited about the Kenyan market for a long time, and there's a ton of lenders who are actually making loans to people who have those M-Pesa, quote unquote, Venmo or PayPal accounts. We thought that would be a great business to get into, but as we really dug into it, we felt that there's a high degree of uncertainty as to how the regulation in that market is going to unfold. There have consistently been views taken by the central bank that these rates are very high, and they have consistently threatened to institute rate caps. And all of these lenders that we were looking at, including the team that I'm referring to, these are unregulated companies. They're allowed to make these high-cost loans to people who have cell phone wallets, but they're not governed by the central bank regulation. And so the idea of giving them a 3-year loan or even a 2-year loan without really having that confidence that we weren't going to be negatively impacted by any kind of regulation, that idea was a bit too scary for us. So we spent a lot of time analyzing the team, analyzing the portfolio data, getting comfortable with that, thinking about a deal. But ultimately, at the stage where we were really vetting the regulatory framework, we felt that it was too much of a risk. And I still feel that way for Kenya at the moment. Not any lender in Kenya, but specifically unregulated, mobile lenders providing these kind of small ticket, high price loans.
I hear that. I think we'll get to a question related to that actually that came in a little bit.
Sure.
But coming back though, so far we've talked through basically two types of teams. One in terms of where you decided to move forward with, where you didn't move forward with, and why you didn't move forward as a function really of, other things may have checked the boxes, but regulation from a macro perspective is really, what ended up causing you to derail that opportunity. But let's say going towards that first investment and anyone that's like them that you end up ultimately partnering with that team. Talk us through, how you generally manage your post-investment process. So how do you manage the credit risk? So the risk of the team being able to actually repay you. How do you manage the operational risk with respect to, for example, COVID? How did, understanding how teams can react to changing dynamics in the state or country that they're in. And also, how do you manage foreign exchange risk? Because at the end of the day, is many of these teams, or almost all your teams, aren't operating in anything dollar denominated, so they have the foreign exchange risk that usually works against them.
Right. So we have to do the kind of monitoring you're talking about at different levels. So there's the loan data, how well is the loan portfolio performing, and that we tackle by having a real-time, always-on live connection to the loan management system of the company we've loaned money to. So at any given time and on a daily basis, we're looking at, okay, is our collateral getting repaid on time? If the collateral we took was $5 million of microfinance loans or digital loans, are the repayments of those loans coming back on time? So that is, level one. And that's something, as I mentioned, we have a real-time connection. We're also stamping that collateral on the blockchain more and more for each deal on a daily basis, so we know exactly which loans are our loans and not somebody else's. So the tech side of things is important to us. And then the other level, or one of the other levels we have to deal with, is how well is the business doing, And there we look at monthly, for every deal on a monthly basis, how are they performing financially? And we have a call every month with every company to understand how that's going and what's happening in the market, et cetera, et cetera. So those two are big parts of it. And then the last thing I think I'd add is, it's really important to us that we have strong working relationships with all of our borrowers. They like us as investors because we have a lot of operating experience, we have a lot of lessons learned, we have a lot of networks, we can introduce them, and we continuously introduce them to other investors and equity investors, et cetera. So I think that strong bond that we form with every team we work with is huge, and that helps us actually head off problems that might come up because we're in close touch with them frequently on WhatsApp, every week, and finding out what's going on, aside from all the formal processes we put in place. I think you asked about FX also. So FX
Yes.
is, that's just it's kind of a no-brainer for us that it's just got to be hedged. And so every deal we do, there's a hedge in place to protect against the wild swings in currency movements. So, we never want to be at a point where we're doing a deal and we're worried what's going to happen to the currency this week or next week. We're always protected.
Okay. I mean, it's also really interesting going back to one of the earlier things you had mentioned about calls every month is that frankly, if you have that much interaction with the teams that you're partnered with, that actually sounds like more interaction their own equity investors are getting, frankly, in terms of understanding the ins and outs of their businesses.
Right.
So, okay. Well, that's fantastic.
And it has to be that way because the equity investors can sit around. I mean, I'm, on the investment committee of a private equity fund here in New York, and we've got 7-year horizon. So we put in 10, 15 million bucks, but if things go bad 1 year, we can weather it out. Whereas at Alma, we've got a loan repayment or an interest payment due next month, and I got to make sure that, everything is on track for that to happen.
Yeah, having helped build up a credit fund prior to this, I can appreciate the pain and work you put going through that. So I hear you there. And so I actually would say like we're going to transition now. We have like about 2 questions that came through. So just transitioning into the open questions, closing off, like just generally think about how you make your decisions and whatnot. And Yeah, an interesting question came in just to share this with you is, and you touched on this before in the context of Kenya with regards to rates that people pay that might be uncapped. So generally, how do you, really, I'll just read it verbatim. Like, so how can low income groups pay essentially such high interest rates? How is it sustainable?
This is a very good question and very commonly asked, and or sort of counterintuitive. So there's a few ways of answering this. One is, if you look at typical interest rates, they're not apples to apples across countries. So in the US, if I get a mortgage for a house, I might pay 3%. In India, if I just put money in the bank, the interest I earn is 6%. So obviously, if I'm getting a loan as a mortgage, it's going to be somewhere north of that. It's usually 9 to 12% or so. So interest rates across countries is not, you can't just compare the two numbers. You have to look at what's the interest rate environment in that specific country. So in many of the countries we work in, the no risk, zero risk, put money in the bank and just earn a rate gets you 6%. So, rates that consumers pay, rates that small businesses pay are considerably higher. And to us who, let's say come from a low interest rate environment sound bonkers, but they're quite normal in those countries. So that's number one. Number two is, when you look at a sector like small business finance, you're talking about lending to a mom and pop store that is not formally incorporated, where if the business owner wants to take off for a month, he can take off for a month and go away. He doesn't really have formal employees. So these informal enterprises by default are riskier. And so to some extent in many markets, that risk premium plays a role in the price. And then the third thing that I'd add is, if there's many markets around the world, and including in Southeast Asia, for example, where you take a loan of $4, equivalent to $4 in the morning, and at night you pay $5. And this is commonplace. You go to a push cart vendor who's selling vegetables, they'll borrow from somebody in the marketplace $4 in the morning, and they'll pay back $5 at night. That's a 20% rate in one day. In fact, 25% rate in one day. So how is that possible? Well, it's possible because the margins on that vendor's products and his business are so high that he can easily pay 25% a day and still make money to support his family. So in many cases, the economics of the businesses that are loaned to for low-income people all around the world support rates that we would think are uneconomical, but actually do work given how their businesses run. And one of my friends who founded SKS, the MFI that went public, Vikram Akula, wrote an interesting book. And he's been all over the news and things for many years. But he has a whole thing around goat economics. And if you buy a goat, what are the economics of buying a goat? Because that's something that a lot of people do with a microfinance loan in South India. And he sort of walks through in his book how that can support a 25% interest rate, for example, that the woman might pay on an annual basis.
Okay. Actually, what I want to, so taking on into account, I want to add just some pepper two things in from my own experiences, actually. One is, you actually might be helping to solve this. One is credit history, or lack thereof. And then two is that these rates could be viewed on a continuum. So rather than look at it on day one, look at it like over time. So with regards to Lend Ledger, given there's a lack of history, essentially a lot of these teams are going through many different analytical exercises to figure out how much they can lend and how safely they can lend in getting basically their capital back. But really their first loans are probably some of the most riskiest that they take. So as an investor or lender or whatever it is you're doing, I would argue many people are saying we need to provide a higher cost loan because of all the risk that we're taking, because we don't have as much information as you would have in the US or Europe when you're lending to someone. Though just to be extra clear, that's not at all to say that there are plenty of people who are providing predatory loans, and really the balancing is with respect to the team that's lending, what's their intent in terms of providing sustainable loans in terms of costs. And that speaks to the second point, which is the continuum. And I'd say in my own experiences, more almost always the first loan is of course like the most expensive, but many times, probably after loan 2, 3, 4, what you find is that the loans will come down dramatically in cost, and in addition to that, the amount of time someone can borrow for will increase dramatically. So maybe you'll start off in a few days or a week or something like that, but then over the course of a few months, and they build credit history, they can decrease the costs and increase the time that they can have a loan from a few days to a week to a few months, 6 months, something like that. So
Right.
I'd say like those two things would get added. I'd add that to what you had shared from my own
Absolutely.
experience.
Absolutely. Yep. The information asymmetry, the operating costs, all of those play a role. More and more, I feel like, with data, like you're talking about, with digital, those are going to get whittled down, and we should see rates come down over time, just with all the technologies and systems that are being put in place.
Okay. And just looking through some of the we have, I'd say like just for the sake of time, the final question that I'll come to really goes back to your funnel, also tying into really frankly like thoughts on Goldfinch and whatnot with regards to why coming here is. Can you help frame for everyone essentially like what is the top of funnel, like, or in broad brushstrokes, how big of the demand are you seeing in terms of what you're looking at? You mentioned this a bit earlier, in terms of total capital you're looking to deploy. And then with regards to that, what are your thoughts in terms of the, coming to Goldfinch? How much do you think or expect or would like to come to the platform, basically to the protocol with?
So I think that there's no point, but I'm excited by the opportunity because it's so big. We said that small business lending, emerging markets, that's a multi-trillion-dollar gap. There's just not enough loans out there. So as you've got more companies making those loans, and they're going to need money, the opportunity for an Alma, the opportunity for a Goldfinch is billions of dollars easily. So we would love to hit $1 billion with Goldfinch. I mean, I think there's, we could take a few years to do it, of course, but the opportunity is out there. There's really no reason why. And this is not to say that we're displacing local banks. It's not that we're displacing hedge funds. It's not that we're displacing other sources of capital. There's a role for the people that Goldfinch is attracting, both the individuals and institutions. They're a really important part of the capital stack for inclusive lenders, for carbon projects. And I think it's, you guys and us who are designing a system to really unlock the capital and put it there. So I think the sky's the limit. I've done this kind of stuff for 20 years, I probably have maybe 20 years left to do this kind of stuff. And if it's the kind of change I've seen in the last 20 years, I mean, $1 billion is chump change. I mean, we're going to be far bigger than that, and we could be, 20 years from now.
Well, on the timing, I hear you there. I may not look it, but I probably have that much or less time in May as well. But in any case, so with that, I just want to say thank you again for the time. And I just want to also give a shout out to Andrew as well. Like, we'll be sharing, just for everyone's context, some more information over the course of tomorrow with respect to details regarding when the pool will be opening. And if you have any questions, as you've done thus far, please just drop it into Discord, and we'll get to it. But either through some combination of ourselves and the Goldfinch team, or Gautam and Alma, given like they are the ones who are actually raising and running everything.
Awesome. Thank you. Thanks to Andrew and the team and everybody at Goldfinch for hosting us, for making this possible. And yeah, we're looking forward to kicking butt and doing a lot more together, making a big impact.
Let's do this again. So yeah, thank you for the time, and have a good rest of your day.
Great. See ya. Take care.
Right.